KiwiSaver is New Zealand's key retirement savings scheme with close to $100 billion now being invested in the program. Choosing the wrong fund at the start of your journey can cost you literally hundreds of thousands of dollars by the time you retire. Don't believe me? Let me show you. American financial research firm Morningstar has published a paper comparing KiwiSaver returns over the past 10 years, a safe period of time to assess how good the fund managers really are. Looking at the balanced funds, the worst performer was the AMP Moderate Balanced Fund, earning a return of just 4.3%. Looking over at the highest performing fund, the Milford Balanced Fund, it earned a whopping 8.5%, roughly double. If we assume a savings rate of just $50 a week, if we were in the Milford Balanced Fund, we would have over $1.2 million saved over a 45-year working career. If, on the other hand, we were in the AMP Balanced Fund, earning a measly 4.3%, we'd have about $350,000, over $800,000 less just by picking the wrong fund. This is why the government has shaken up the default funds last year, and why you need to continue watching this video to learn more about the top performing funds over the past 10 years. Now, the past doesn't always repeat, but over a 10-year span, we get a pretty good idea of how good these fund managers really are. If you haven't already, please make sure to subscribe to my channel down below to see more content just like this in the personal finance and investing space. Also make sure to check out the ShareSite website below, as they offer what is perhaps the best investment portfolio tracking service in the market. They have kindly offered 4 months free to all of my subscribers that sign up for an annual plan. So make sure you check them out down below using the link. So as I was saying earlier, the American financial research firm Morningstar publishes a report every 3 years or so where they dive into the KiwiSaver stats. They talk about all the news that have impacted KiwiSaver funds over the past 3 months and how they performed on average. Skipping past all of this, we get a nice few pages filled with tables showing us how the funds have performed over the past 3 months to 10 years. On one hand, we could evaluate KiwiSaver funds by their performance over the past 3 months. The problem with this is that the time duration is too short, and we are wanting to invest in KiwiSaver over a much longer period of time. If we join the scheme at 20 years old, it might be 10 years before you buy your first home, or 45 years if you want to invest over an entire working career. It therefore doesn't make much sense to look at the shorter term returns. Another consideration is that a KiwiSaver fund is only as good as the people managing it. They are the ones that take your money and invest it on your behalf into stocks, bonds, that kind of thing. If they are smart, they'll do this well and generate high returns for you and your KiwiSaver fund. If they suck on the other hand, then so will the returns. In the short term, a fund manager such as ANZ, Milford or Fisher Funds might have a great team full of smart people. However, over a 10-year period, we would have to assume many of the team will have left the fund manager to go on to other opportunities. The fund manager would then need to rehire people just as smart and talented to ensure their returns remain good. It is for this reason, among others, that we must compare the 10-year KiwiSaver returns to have confidence in the fund manager and their ability to sustainably generate high returns for your KiwiSaver account over the longer term. Let's now jump into the data to see which funds have performed the best over the past 10 years. First up, we have the conservative funds. These are generally the least risky funds that you can invest in through KiwiSaver. If you are afraid of risk, needing to withdraw your funds in the short term, or perhaps for some other reason, this is the category for you. If we take a look at Morningstar's analysis of average funds by risk tolerance, you can see that conservative funds on average had the lowest return of just 3.9% over the past 10 years. Aggressive funds, the most riskiest of all, generated a much higher 8% on average. The old saying of higher risk, higher return tends to always play out over the longer term, as you can see here. Back to the conservative funds, 9 have been in the market for at least the last 10 years, and can therefore be compared. In first place, we have the Milford Conservative Fund, generating an average annual return of 5.7% over the past decade. In second place is Key Street Conservative at 4.4%, and third place is Fisher II Cash Enhanced Fund at 4.1%. Next up is the moderate funds. These are slightly riskier than the conservative funds as they invest a greater portion of their investment funds into growth and overseas assets. This could include more stocks like the Warehouse or Fletcher Building, real estate trusts like Kiwi Property Group that own Sylvia Park Shopping Mall, or overseas stocks like Apple and Pfizer. On average, these funds have an average annual return of 4.3% over the past decade. There are 12 moderate funds that have been in the market for over 10 years, with the highest performer being the Generate Moderate Fund with a return of 5.2%. This has been a consistent fund, also generating the highest returns over the past 5 years. Second place goes to the BNZ Moderate Fund at 5%, and third place to the Mass Moderate Fund at 4.8%. Now we get to balanced funds, which are halfway between conservative and aggressive funds. They have a strong weighting towards safer cash-based investments like bonds and term deposits, but they balance this with an also strong weighting towards riskier stocks, property, and overseas investments. On average, these funds generated an average annual return of 6.1% over the past decade. A whopping 16 funds have been in the market for at least 10 years, with the highest returns being generated by the Milford Balanced Fund, with a return of 8.5%. It also has the top 5-year return and the second best 3-year return. Trailing them is the Superlife Ethicate Fund, which earned 7%, and the Key Street Balanced Fund slipped into third place with returns of 6.8%. Now we've reached the most popular fund category for New Zealand KiwiSaver investors, growth funds. Roughly a third of all KiwiSaver assets, or $32 billion from the $96 billion total, sits in growth funds. This is pleasing to see, as it shows that most New Zealanders recognise the long-term nature of their KiwiSaver investment and have moved into riskier funds that are proven to generate higher returns over the long run. These funds, of course, put more of the money invested into riskier assets, as we covered earlier, which are more volatile with their price going up and down, but it evens out over the long term with superior returns. The average return for these 14 funds was 7.6% over the past decade, with the Milford Active Growth Fund having the highest returns of 10.1%. This fund is exceptional, as it has generated the highest returns for the past 3, 5, and 10 years. It's also one of the bigger funds in the market, with over $4 billion under management. In second place was the Generate Growth Fund with returns of 8.3%, and in third place was the Fisher Funds Growth Fund, earning 7.8%. Finally, we have reached the last KiwiSaver category, aggressive funds, which, as the name suggests, is almost exclusively invested in growth assets. This, of course, comes with the greatest volatility, as growth asset prices move up and down much more viciously than the value of a bond, for example. Among the 8 funds that have traded for over 10 years, the average return is 8%. The best performer over the past decade was the Generate Focused Growth Fund, which earned an average annual return of 9%. The lowest performing fund was the AMP Aggressive Fund, which earned a return of just 6.6%. So that rounds out this analysis, exploring the top KiwiSaver funds across all 5 KiwiSaver risk categories. When choosing the right KiwiSaver fund for you, make sure you do your own research to make sure it meets your investment goals, as returns don't always tell the whole story. Mindful Money can be a great resource here if you're concerned about the ESG principles followed by each fund, as they dig into all the details so you don't need to. Also check out the Sorted website, as they have lots of useful tools to screen all 370 KiwiSaver funds currently available in the market. You can also track the returns of all of your investments, even those in KiwiSaver, through a great company called ShareSite. They are currently offering all of my subscribers 4 months free on their annual plans, so make sure you check them out at the link down in the video description. Please also make sure to subscribe to my channel down below so you don't miss any of my future content in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.